Afternoon, everybody. Happy Financial Fitness Friday on a Thursday. Quick disclaimer, as discussed, and for new people here, this is meant for educational purpose only, and there are none of this is specific recommendations or advice. Thanks for coming on video. That helps me, like, so I know if you're bored or whatever, I'll move on, or if people seem to be a little bit confused on a topic, that helps me out. So, if you don't mind, sharing on video, that'd be great. But now I'm going to launch a quick poll. Click here. These are the questions I just asked. So the first question is, do you have umbrella insurance? And only three people said yes, 7 said no, and not surprisingly, a third said, what the heck is umbrella insurance? That's partly why we're here today. The second one, should be the basis of the coverage amount for umbrella insurance? 1/3, 5 out of 15 said value of the total assets you own. 2 said amount of total debt, and 8 of 15 said your net worth. And it really should be your net worth. It really covers your liabilities, so that you protect everything that you own, outright, but not assets, because they're not even going to recover the debt portion of that, say you have on a mortgage. Let's see. 3, when was the last time you checked your liability coverage amounts? 7 out of 15 is the last time policy renewed. That's good, actually. 4 out of 15 a year ago or annually, and then 4 out of 15 were when I initially set it up years ago, which is, I wouldn't be surprised. I mean, it's not something you think about typically, but fortunately nobody said who cares. Do you have life insurance outside the employer provided? 8 out of 15 said yes. 7 out of 15 said no life insurance outside of we have a group life insurance at Viasat, so, which we'll discuss. And then the types of life insurance, 3 out of 15 said term, 4 out of 15 said whole life or permanent, 1 out of 15.
Yes.
Somebody's, and I can hear you talking to somebody else.
Sorry.
No problem. Just letting you know. 1 out of 15 has universal life insurance, and 5 out of 15 have none. I have insurance, a couple of them, but don't know what kind, which is understandable. That's why we're talking about this stuff. 6, how often do you calculate your net worth? 4 out of 15, never done it. 9 out of 15, annually. 0 out of 15, quarterly. That'd be 1 out of 16. That's what I do. And 2 out of 15 monthly. So there's people nerdier than me here. Let's see. 7, do you have an IRA? 5 out of 15 have a Roth. 3 out of 15 have a traditional. 5 out of 15 have both. And what's an IRA is 2 out of 15. So we can answer that question. That's important, and everybody should get one this year before the calendar year ends. Preferably, I like Roth. I have both though, because we can also talk about backdoor Roth. It's a separate topic, where you do need a traditional and a Roth. Do you max fund your Roth, your IRA annually? Only 3 out of 15 said yes. Okay, I hope to get that number much higher. 10 out of 15 said no. 2 obviously said can't because I don't have one. And the last question, if you don't already have max of 401k, not max match, max amount, like the 20,500 this year, which is the limit, have you set up auto increase? 2 out of 15 said yes. 7 out of 15 said no. Fortunately, 6 out of 15, that's great, already max funding. That's good. And then fortunately, good. Another thing, everybody is at least contributing. But people that said no, if you're not, you should at least 1%. I'd say 1% every 6 months. You won't notice the difference, and you'll thank yourself later. Okay. Any questions on those polls, or why we did it? Basically, today we're here to talk really about umbrella and life insurance. And bottom line up front, many people don't know about umbrella insurance, and they often think about life insurance protection. They don't think about life insurance protection until it's too late. Everybody kind of thinks they're invincible when they're young, but world not a fair place. This is important because not having adequate umbrella insurance and or life insurance coverage could potentially put you and or your family in serious financial peril. What I'd like you to be able to do by the end of this is have a good understanding of both umbrella insurance and the different types of life insurance, and be armed to then immediately go and take necessary immediate actions to ensure you and your family are protected. Any questions there? Oh, okay. Here's the agenda. Stop sharing this. We're going to quickly go through since the new 2023 limits, contribution limits and everything are out. We'll quickly go over those and other things that impact us as taxpayers. Okay, some of you are familiar with this. These are when I did your investing retirement vehicles. Here's how I kind of broke them down. You've got your 401k. I consider that a dump truck because you can put so much in compared to other qualified accounts. Health savings account, the fire truck, it's there when you need it, but the best thing to do is you take care of it and invest it, and you can use that many years down the road, and pay for stuff with current pay for medical stuff out of pocket, and then you can reimburse yourself 20, 30, 50 years later after that money's grown triple tax advantaged. The IRA is, I really think of the Roth as military grade because of its flexibility and preventing you from having RMDs, and that's why seeing that some people don't even have one, something you want to buy, you want to open and fund as soon as you can, in my opinion. And there's 5-year rules that we need to talk about at some point on Roth. A brokerage account, that one I called it tow truck because it pulls you through to normal qualified retirement age of 59 and a half, provides that money. And then Social Security, I kind of cut it into like a, say, 70%. I don't think it's going away. Even if the trust fund goes away, we're still funding it with workers at 75%, or really 77%. But that's your best long-term annuity because it's also COLA adjusted as well. So I call it, I show that as a civic, but it's maybe it's sliced off a little bit. And hopefully those make sense. Okay, 401k. They've updated the overall umbrella of the 401k. It's went up to 66,000, which is up 5,000 from last year. And if for people 50 and over, that's 73,500 due to catch-up contributions of $7,500. The normal means the employee elective deferrals, that's what we can contribute this year, 20,500, and then the company match. But there's actually like under that umbrella, there's a much larger portion that you could put in, and I put some additional things on the side that you can use to pump up that total amount. And as mentioned, there's no income limits on the 401k. Can contribute pre-tax, Roth, or a combination of both, at least on our plan, and most companies are getting that way as well. Please ask questions as they come up, but I'm kind of moving through these quickly just so these aren't really heavy topics, just kind of show what these next few are just so you can start doing your planning and update your allocations now to start taking advantage of the new limits. So updated 401k limits, and this includes 403b, 457, all those types of accounts. TSP, it went from 20,500 up 2,000 due to inflation to 22,500. Also, the catch-up contributions for people 50 and over, that went up from 6,500 to 7,500. So as you can see, people can contribute. The employee alone now can contribute 22,500, 50 and over 30,000 a year, and there's still an additional, room for 43,500. That goes into what the mega backdoor Roth is, which we don't have at this company yet, but pushing to get it. They stopped initially because Congress was trying to get rid of it, but they haven't. So something we'll have to hit up our benefits again to try to push through for that mega backdoor Roth. Any questions on the updated limit for 401ks? Make sure you're taking advantage of it. So start making your changes in allocations now. Okay, Roth IRA limits. And you see here at the start, look, a lot of numbers, but I have both the income limits and the actual contribution limits. So Roth IRAs, all the IRAs went up $500 from $6,000 to $6,500. No change in the catch-up, which is $1,000 more if you're 50 and over. But you notice the income limits went up for the Roth. So you got 138 for single. The phase out, meaning if you make 153K or more, you can't contribute directly to a Roth. You still have the backdoor Roth available, which means we've talked about that before. That's contributing to a non-deductible traditional IRA contribution, and then you convert that to a Roth IRA. Voila, money's in the Roth, grows tax-free forever. And then you can see down here the limits on the traditional IRA for anybody that has a 401k plan and is participating. Very small limits, income limits there to actually be able to contribute to a traditional Roth. So for most people, Roth is the way to go, Roth IRA, and the backdoor is available as well. Still, any questions on this? Note, if you do not have a Roth, an IRA, you can see I like Roth. Open it now. I'm a big fan of, Schwab, Fidelity, and Vanguard, the low-cost discount brokers. But if you can fund that $6,000 for 2022 up through tax day of April 15th this year, and that's true every year. You can fund up to the tax year. 401k and at the end of the calendar year, that's it. But you could now, if you don't have an IRA, you could open it and have 6 months basically to fund that before the window for 2022 closes. Okay, health savings account. So it's bumped up as well. $200 for individuals, $450 to $77.50 for family, and then no change in the catch-up contributions as well there. But something to know for our company: if you're on the high deductible plan and contributing to an HSA, you can also contribute to a limited use FSA, which is the flexible spending account. That's to use it or lose it. If you don't use that money, you lose it. But if you have an HSA, you could fully fund that. But you could also take an FSA for dental and vision and use money for those things that comes out, so it's tax-free money there. But you have to remember, make sure that you use it. But not all plans allow both the HSA and FSA. So any questions there? That's kind of, I kind of ran over that quick, but that's important. Okay. And Social Security, largest increase in 40 years, up 8.7%. And I just kind of showed a breakdown of what it is. For employees, that Medicare, the FICA tax comes out to 7.65% total. And what they did is increase the maximum taxable earnings significantly this year from 147K to 160.2K. So if you make $160,000 or more, the real impact is you're going to pay another almost 820 in tax this coming year, just really to support that increase, and really I'd say probably the longevity of Social Security. Any questions there? Okay, and this just shows the overall increases in Social Security. You can see this has been, since 1982. This is the highest increase when we had the crazy inflation of the late 70s, early 80s. Now into the real topic of umbrella insurance and life insurance. So, what is a personal liability umbrella insurance? This, as it says, protects it's added liability protection against negligent acts, but it's very cheap. It's like $150 to $300 per $1 million of coverage, and that's per year. It depends on how many cars and how many homes you have. So if you have fewer homes and cars, your actual policy amount is lower, but really it doesn't even matter. $300 for $1 million of coverage is really insignificant. So like I said, what really is for homeowners, renters insurance, and auto, additional liability protection to protect you against suits. You know, if somebody slips and falls, whatever on your property, get in an accident where you're at fault, this saves you from losing your whole net worth. So it does require additional liability limits above the normal limits. And if you look at the normal limits, it's kind of crazy. You know, bodily damage in California, I put a few states. California, it's 15K. These are all in thousands of dollars for bodily damage per person. I mean, that'll get somebody an ambulance to the hospital. I mean, what's that going to cover? You know, but 15, 30, and 5. I know for USA, which is the insurance company I use, the minimums are 300, 500, and 100. You know, which is significantly, you could tell, higher than the state minimums. And then homeowners is 300K. So that's important to know, and your insurance company will know those, and they will update your policies accordingly. But you could go then later and lower those liability limits, which is not a good idea. We'll go into that. But any questions here on overall umbrella insurance, what it covers, and obviously how important and silly it is not to get?
Hey, Alan.
Yes.
So umbrella insurance is on the top of homeowners insurance.
And auto insurance. Yep. It's basically supplements the liability coverage on those.
Okay.
Makes sense?
So does it, if you have an umbrella insurance and somebody sues you, would they go for the more money because you have a bigger insurance than?
They don't know what your insurance is. They're going to go after, like, just how I have the evil, you know, Better Call Saul lawyer. We live in a very litigious society, and so people are going to go after you for as much as they can. And it doesn't matter whether you have umbrella insurance or not. They're going to go after you. And so what you need to do is have umbrella insurance to cover all that your net worth is, so that they don't really take anything from you. Does that make sense?
Yes.
Okay. Any questions or any? So there's some insurance experts out there too. If I'm saying anything you think is a little inaccurate or needs better explanation, let me know.
Is it
Yes,
the homeowners same as renters, or those are the two different insurances? Because I know the renter insurance can cover for stolen.
Umbrella sits on top of homeowners, renters, and auto insurance. So you have to have those liability limits, additional liability limits on all those policies. But then umbrella sits on top of all of those for that additional protection. Make sense? Does that answer your question, Shama?
I'm getting a little bit off the topic, maybe. But I have seen the renter insurance has covered for the loss. Let's say I have a bicycle and I'm riding somewhere and somebody stole it. Does the homeowners insurance act same as renters insurance?
Homeowners does. There's a certain amount of protection. Those go into, I guess that's kind of a little bit beyond the scope here, but yes, it does cover a certain amount of that, but it's limited. But it covers even like stuff in storage. If you have a storage unit, it covers that as well, up to a certain amount, which is kind of limited. And if you have really expensive valuables, you have to have a separate policy to cover those specific things, like jewelry, like, you know, things like that. Above, I think it's 2,500 for most insurance companies for individual items. Okay. So any other questions?
I have a question for you, Alan.
Yep.
This is new to me, so thank you for introducing me to this. I just want to check my understanding. It sounds like you're saying umbrella insurance is functionally an extension of the liability insurance I already have through home and car and such. And
exactly.
At the end of an event, it functions the same. I think what you're saying, though, is it just is way more affordable than just cranking up the liability numbers on my base insurance policy?
And actually, you can't even raise your liability numbers above a certain limit. I think they have maximums. Like the ones I just showed you previously, the USA, I think those, I'm pretty certain those are the maximum liability limits on auto insurance, 300, 500, 100K. And, you know, so those are, there's a limit. But yes, it's much, in general though, it's much cheaper. And then we'll go into it, Chris. Here's the example of how this works. So John Doe has $1 million umbrella policy. He has the auto liability of required of 300K per person. And he gets an accident and has a suit of 750K against him. Auto policy covers that first 300K. Umbrella policy covers the remaining 450K. Nothing comes out of pocket except for your typical deductible, deductibles. So key thing, we have some homework later, but go check out your policies and update them and get that umbrella insurance. 150 to 300. You got to know your net worth though as well. It's better to go above than a little below. Now we'll go into another example.
Hey, Alan,
What if, yeah,
quick question. So is kind of the best approach there then to just go contact your existing insurance provider and then see how much or about adding this to that?
yes, that's
Okay.
exactly. And that's what I do. I mean, and it depends on, like I use USA. Here's insurance, you want a good company. Like don't go with the cheapest thing out there. What you want is the protection there when it matters. So, you know, I'm saying going for the most expensive, you know, you can use, and I got later things to look these things up, but, you know, but yeah, just go through your normal insurance and they'll have an umbrella, be able to explain the limits and make sure the rest of your stuff's updated. But you could, here's an example that I'm showing is somebody could get umbrella insurance and then go back in and change their auto liability and drop it down. And beware, that's not something you want to do. But people, you know, would try to save a few bucks. It's obviously more liability coverage is going to cost you a little more every 6 months on auto insurance and annually on your homeowners. But so this person, Jack, decides he's got $1 million policy, umbrella policy, and he decides to skimp and go, instead of use of 300K, he goes back down to the minimums, you know, 15K to save 150 bucks every 6 months. He has an accident, same $750 suit. Now the auto policy only pays that liability limit. He went down to a 15K. Umbrella policy doesn't cover, it only covers above what you were supposed to have. So that difference from 300K of liability cover she was required to have, that's on the Jack. So he's going to have an uninsured loss of $285,000 just because he tried to skimp on the liability coverage. Yeah, don't be a jackass. Any questions there?
Really good example.
Okay, now why purchase life insurance? Okay, is it an investment? Is that the main reason? I wouldn't consider that the primary reason at all. And be skeptical about you know, for the cash values, the rates of return, the graphs you see, that these aren't guaranteed. The primary reason for insurance, even though you can use it also as an investment, is income replacement to support an insured dependence. So if people depend on your money, that's what your income, that's really what the primary purpose of life insurance is in case of a, you know, tragic accident. And so that you're covered for life. And here's some examples of specific things that is, you know, examples of what it's to be used for. So what if you're single, young, no dependents, and nobody depends on your income? Should you not get insurance? What do you think?
You don't need insurance because nobody's dependent on you.
You don't, but down the road, you might. And here's considerations to put into place. I'm not saying go get it, but when you're young and you don't have any medical issues, especially like term insurance is super cheap. It's a consideration because, and look at your family history. What if it's very common a medical issue that down the road you're uninsurable when you want to get life insurance. So it's Shama, you're right. Nobody depends on you, but it's just a consideration to have, and you could look at how cheap it is, you know, when you're really young for term insurance. Any questions on this? It's just something I like to bring up that, hey, it's important considerations to think about long term. Yep.
Is there a time to have a life insurance? Because as you get old, do you need a life insurance?
We'll go into that. I'm a believer in investing and utilize, but you need life insurance for protection until you're financially independent and can self-insure. But we'll go into it. And here we're going into this is sorry.
Quick question there, Alan.
Yep.
I'm just curious about the opposite direction. How young is too young? And I'm thinking of my son.
And that's it. That you can get things really cheap for children, but is it necessary? I don't. That's Chris. That's a tough question, and maybe
Will he thank me 50 years from now because I got him a super cheap life insurance policy or something?
Maybe. I wish there's some people on here. I know some people have, their parents did that. Maybe this is part of, actually, Chris, this is part of the discussion I'd much rather go into is and it's a whole separate topic, is funding and investing for your children, because this is a way to potentially do that. There's also, you know, 529 plans for school. There's UTMAs, these accounts basically that become their property at 18. Normally that's most state ages, or you can just fund a brokerage account and gift it to them later. There's different ways to help your children out, and life insurance is one of those ways. But that's something I'd really much rather dig into it deeper in another topic that we'll hopefully do soon. Is that okay?
Yeah,
I don't mean to
of
blow
course,
you off, but and Brittany or Royce, you guys might be able to, you know, if you want to say something real quick on that. They're insurance experts, better than I am on this, and so if they want to pipe in their 2 cents, be happy to hear it.
You want to say something, Brittany?
Yeah, so Chris, I guess the question that you asked is, when is too young? That's, you know, nobody ever has that crystal ball of knowing what's going to happen when. And a lot of times where I have people most of the time have those concerns, especially medically speaking, is diabetes part of the family history? If you know, it skips generations, and that's something that instantly becomes uninsurable. So if that's a concern and we need to get ahead of it, this would absolutely make sense to do something while the timing is available. You know, there's other examples where, you know, I'll hear about children that pass away and parents may not have the funding available to support those final expense costs. Of course, it's a dark topic. Nobody ever wants to think that it's going to happen to their kids. Nobody wishes it upon anybody. But if we don't have the plans in place, that could be something to consider as well.
Good points. Yeah. Thank you, Brittany.
And if I could jump in on the aspect of like when it's too young, and you asked the question like, will my child thank me down the road, right? Well, I think that depends on what policy you're looking at. So you have to be really careful on like, okay, and talk with one of us on how that's set up, because if you set a child policy up in place and it's meant to transfer that they're going to continue to pay on it, and they choose not to continue to pay on it and it lapses, then it did you no good. But if you set it up correctly and it's, you know, it's either paid up by the time that they're 18, or you know, there's some ways that you can kind of look at that that makes a little bit more sense, that it will stay in place for them long term, and therefore the coverage would be cheaper. And, you know, we can just kind of look at what that actually looks like. so that it actually does benefit them long term. So it can go both ways, but you have to know what you're buying.
Yep,
Yeah.
good point, Royce. Glad you said that, because Chris, that's what I was thinking is, if you leave it up to your kids to have to fund it later, they might, they might not, and then it could
Sure.
lapse, and then it's kind of a waste.
Sure.
But no,
Okay, thanks.
thanks, Brittany and Royce.
Appreciate all the
it.
points.
Good.
Sorry about the derail there, Alan.
No, not at all. And actually, Brittany and I were talking about that, and I said this is something I want to go much more in depth. Talk about when we talk about investing for your children. Okay, quickly, this is for our company. What our group life insurance is. We have up to 3 times our annual earnings, up to a limit of 750K. I remember hearing before that if you died on the job, it was up to 10 times, but I didn't see that in the policy. So maybe they removed that, but you can as well. If you leave your job, you can change your group life insurance to an individual policy. And then there's a link to the wiki that talks all about this accidental AD&D, accidental death and dismemberment insurance as well. I kind of think of this like an uncertain term insurance, because you get fired, get laid off, you quit, and don't do anything. That coverage is gone, just like that. So, okay, now also we got military and veterans in here as well, or ones with dependents. Here's just SGLI, which is, what we have for active duty members and, reserve, et cetera, up to 400K, cheap insurance, like $24 a month for the max. And you can convert this to VGLI within, if you convert it within 240 days of leaving active duty, you can get VGLI without proof of health. You wait after that, then you have to prove you're healthy. So VGLI is important if you have medical conditions that are uninsurable. If not, it's an expensive term insurance, basically, in my opinion. It goes up, it's renewable every 5 years, which for people with a medical issue is great. That's guaranteed. But so long as the premiums get paid, and the premiums keep getting more expensive as time goes on. But you can also convert VGLI to a commercial whole life policy without proof of good health. That's significant as well. So any questions there? Royce, I see you laughing about something. I don't know, maybe you don't.
It's not this. I was looking at something else.
Okay.
Sorry, buddy.
No. Okay, so how much life insurance do you need? You often hear probably a rule of thumb of 10 times your income. Is that really a good basis? What about young people and they're just starting out, and then 5 years down the road, they're making twice the amount of money? So, okay, what was 10? That 10 times doesn't make sense anymore. Or which 10 times do you use? Which salary? There was really 3 common approaches used by financial planners, and we'll go into each of these just so people understand them. Human life value approach, needs approach, and the capitalized earnings approach, which the last one, not really a big fan of, but it's just figured I'd show you guys about it. Closer to financial freedom, financial independence, Shama, this goes back at what you're talking about. Maybe just the elimination of debt is all that's needed, because you fund it, you have enough money to provide income for the rest of your dependents, dependents' lives, so you're self-insured. Does that answer kind of what your question was earlier? Like, do you need it later? And that's where we'll get into term versus whole, and options there. Okay. And people just stop me if you have questions. We'll quickly go over, because I'm a nerd and some of you might be too. Just a quick basic understanding. And why we're doing this is that way all of these things, and whether you use a financial planner or not, or you have to have skin in the game. You cannot hand this over to other people. You have to be thoughtful about it and make sure that you're getting the right protection you need, the right, and that it makes sense for you and your family, both in terms of insurance and that's investments and everything else. You always should be a big player. But these are the basic steps of it. It's a little more difficult. I kind of like the needs approach a little bit better, but this is, we'll walk through an example of the human life. So Diane, she supports Jack, was the dummy with the liability issue. So quick, age 40 earns 100K. So removing what her consumption basically is in taxes, we'll just say that's 50%. So 50% supports the family. And then she's planning to work another 20 years and retire at age 60. Use say a raise of 4% a year and gives you a future value of nearly 1.5 million. Now you take that discounted back based on inflation, it gives you an amount of 680K today that you need for a policy. And life insurance policies have these various breakpoints, so you probably get a 750K coverage at a minimum. That makes sense? Okay. Now the needs approach. This one I actually like better. I think it makes more sense because it hits on, it looks at specific things, and some that remain, some that go away over time. And so it's, I think, a better planning. By the way, the blackout period is considered that time from retirement until Social Security kicks in. Okay, here's a calculation for the needs approach calculation. I just put in the basic numbers, some estimates. And on the top one, you see like that, the funeral is always going to be there. The needs at time of death for your, whatever, how you dispose of your body, that'll always be there. Probably some medical, towards the end. Probate, hopefully not, if you set up your estate plan right, but it's those are pretty permanent. But this comes out to a total of 1.8K when you add up all these, the mortgage, the education, all those start to go away though over time, right? As you pass those milestones, shall we say, you pay off the debt, et cetera. But that's a good calculation showing, hey, what you need now, and then you can maybe make adjustments. Did I say earlier? Oh, on the term, like using the 10 times your salary. One thing about term insurance is you can stack those on top of each other. So you get a term insurance, say when you were 25 or something, and then you realize you get married, whatever, children, and you need more coverage. You can buy another policy on top of that. And so they just stack on top of each other, just separate policies. Good to know. Okay, capitalized earnings approach. It's kind of like a modified human life, and you just don't, you don't have to figure out how long the work life expectancy, and it's just a very rudimentary, I think, calculation. Personally, I like the other two methods and the needs based method the most myself, but figured I'd just show you guys for the last bit of nerdiness, the capitalized earnings approach. And that way also you can know if you meet with somebody and they say you're doing this, you can say, hey, I don't like that approach. Let's go with, I want to see a needs analysis. So any questions here? Okay, now we're going to types of life insurance. So there in the little funnel there, you see term insurance, universal, and whole life. Whole life is same as permanent. Term insurance, it's limited a certain term, a certain amount of time. It's inexpensive for a large amount of coverage. And it's inexpensive because most of these policies lapse. If you get a 20-year term insurance, in 20 years, you die a day after 20 years, no death benefit. So the insurance company doesn't pay anything. So that's why they're inexpensive. But in my opinion, this is the best. This is the solution for vast majority of people, so long as you're doing everything else right. Because as you save and invest over time, you're building yourself towards financial independence. And once you're financially independent, you're self-insured, and you don't really need life insurance or your depends. Permanent whole life, it's lifetime protection, so long as premiums are paid. I put an asterisk there because I'm not sure how often premiums actually lapse or surrendered, and it's hard to find that information, which to me tells me it's more often than I'd like. But because otherwise you think that information would be readily available. Don't you agree? but it's expensive relative to term, but it's got a cash value savings component that a term does not have. And you can use to get tax-free loans on that cash value. It's whole life is if you have special needs children, whole life is important. Is more than just doing that though. Estate planning and trusts you'll need to set up as well to make sure that you're not losing out on government assistance for special needs children that are available, and you could mess that up with if you don't structure your whole estate plan accordingly. I also say it's for the very rich, because in my opinion, that you can invest so much more. You know, when you look at just investing in your 401k, the IRA, say you some brokerage account. If you maxed all of the 401k and the IRA for 2023, that's, let's see here, and say you put $1,000 a month towards the towards a brokerage account for your shorter long-term goals, right there, that's almost $3,500 a month. You're saving, investing towards the future. Most people in the country don't have more than that per person to save, you know, every month. So that's why I say those things are tax advantaged, means that are low cost, can be low cost, effective means of saving for your retirement, investing for your retirement before you. But once, if you've got all that and you still have extra money, life insurance, whole life is another good way to provide another tax haven for additional savings. But I think there's cheaper ways before that. Any questions here?
Is the universal life same as whole life?
What's that?
You,
Universal?
yes.
We'll get into it. It's different. It's kind of like term with a cash value, kind of a renewable term that can go your whole life, but it's as long as premiums are paid, but it goes, those premiums go up. We'll touch on that here, Shama. We'll get to that. But and you see the bumper, buy term and invest the difference. That's until self-insured. That's kind of how I think in generally, because term is so cheap. Use that extra money to invest. The problem is people don't. So if you don't, then the whole life makes more sense. But you got to invest that difference. So any questions? Okay, types of term insurance. Most use a level term. So you get it, say for, let's say up here at XX, say for 20 years or 30 years. It's the same annual premium over that entire time. But let's say it's 20 years. You see that in that chart. If you die during that 20 years, they receive the entire death benefit. So you had $1 million, like shows $1 million face value on the policy. If you die a day after 20 years and didn't, you know, get additional term insurance, zero death benefit. So it goes away to zero. Annual renewable is the same thing, but the premiums keep going up. So, and as you get older, term policies get exponentially more expensive as your mortality risk goes up. So most people get a level term, makes sense. There is another less common, which I think actually I'm surprised is less common, because it seems to make sense, because as you save and invest, your need for insurance goes down. But they do have decreasing term, but not every company has this. But it's less common, but it's affordable. And as that term goes out, your amount of death benefit drops until zero. Does that make sense? But that's one, Shama, that kind of goes exactly into what you were saying. Like, hey, do you really need it? So as time goes on, your need for death benefit goes down as you self-insure by your own savings and investments.
Okay.
Okay.
Question for you,
Like I
Alan?
said, yep, go ahead.
If I want to go increase my amounts, is it good to just go into my Viasat benefits and bump the levels up, or is this something I should be looking for, like my outside insurance company? Or
I would probably look, you could check, I would probably look at outside, and I'll give you some examples, like using Policy Genius, or some things where they'll compare rates, and you could, really you want to do your due diligence.
Mhm.
But I bet it's, I mean, I'd probably ultimately look outside
Okay,
is what I'm
thanks.
guessing. Yep. Okay, here's the different types of whole life. This is not universal though. There's the ordinary, limited pay, and then variable life. Variable life's not as common. Usually you hear variable universal life, which we'll get into in a moment. But you see there's kind of a difference. The variable life does have, you can invest that portion into various mutual funds by the company. Typically those mutual funds are more expensive, expense ratio wise, than Vanguard, Schwab, or Fidelity, which is 0.02, Fidelity 0 on some funds, up to like 0.04 for Vanguard Total Stock Market Index. Same thing with Schwab and Fidelity. Any questions? Okay, variable universal life policies. These are weird, kind of confusing, not weird, I guess confusing to me. They are like term with cash value. So like two components, and some can be unbundled, they're unbundled, but they go up in cost. Your premiums go up over time with these. Unlike whole life policies, they look at the whole mortality risk the whole time and set up, you have a level, same premium due every month. It covers the, so you when you're young, you're paying more for down the road when that cost would be excessively high if it went just based on your mortality risk. Okay, 3 different options. Option A, you don't get both the cash value, or you get cash value or the death benefit. It's unbundled, but these you can do flexible premiums, and which is people like they can pay when they say people that have a fluctuating income, they can use this this type of policy and not pay as much as long as they have enough that's covered the premiums over time. Option B is is like A, but you get the death benefit and the cash value, so it's more expensive. And then there's variable universal life, which that's where people have tried to, that's where I've heard the most of, I guess. But I put in red, beware of the indexed universal life. That's the one people will sell you on, taking market participation with no downside risk. That's don't believe it. These are capped rates. You don't get dividends, and what the index universal companies like New York Life don't even offer index universal life because it's not good for people. So that says a lot. If a renowned insurance company like that doesn't even offer them, that should scare you. If anybody else trying to sell you on one of those. Any questions here? Okay. What's a MEC? Anybody know offhand? Brittany, Royce, you cannot answer. Neither can you, Ann. I know you. Has anybody heard of a modified endowment contract? So this is what happens when basically a cash value life insurance. Remember, I was talking about being uber rich and people want a tax haven. Well, back in, especially in the 80s, when tax rates were even much higher than they are now, this was the way to go. People were like, yeah, shoving all this money in. And all of a sudden they had this, then later on, when they don't have income, it's kind of like a Roth, or a traditional IRA, or 401k, that they defer all this taxes, and then when their income, the taxes are much lower, they could pull it out. And it's a great way to make a lot of money. But what do you think Congress said? No, they weren't too happy. So they came up with a Tax Reform Act of '86 and provided these MEC rules. And really, a guideline premium and corridor test, you'd have to talk to a good insurance agent to understand that fully. But really, like the 7-pay test is basically if you pay for like the whole life premiums within 7 years, you've paid more than what the lifetime premiums are for that policy, it's become a mech. And then that's, then you get different tax treatment on the money that you pull out. Say you try to pull out money for a loan. Now it goes in as last in LIFO, which is last in, first out. Treatment for maximum taxation. So last in, first out means that all the gains you had on any of that money gets taxed. And so it's a way, and once it's a MEC, it's always a MEC. So you have to make sure if you're funding one of these, you don't turn it into a modified endowment contract. If you don't then pull out any of the cash value, it's not a big deal, but it is a big deal if you try to use that money. Which is what most people wanted it for anyway, but it doesn't impact the death benefit, it's still tax-free, et cetera. Any questions there? I thought I had to explain that though. People need to understand that a modified endowment contract is important to understand if you get into a policy like this. Okay. Now, another a couple of important things, the whole unholy trinity. This is how to screw up tax-free for a life insurance policy. So if you have the parent that's insured their life, a second, the other parent though is a policy owner, and then the insured dies, the policy owner then gives the child as a beneficiary. That's ends up being a gift instead of life insurance, and so you need to make sure you don't set this up. It was like Goodman was the case that went to court where they decided this. So really to prevent this, you just need to make sure the insured person and the policy owner are the same person. Don't split it up between parents. Make sense? Okay. Okay. Trigger words. These are common things that I've heard that and I say at the bottom, it might be a little hard words, but bear markets are breeding grounds for high commission annuities and insurance. Because they'll say risk-free and use the word guarantee. When just be careful. Leaving a legacy, it is a way to leave legacy, but investments could do that as well. And just as a reminder, we've talked about this before, but you should want to help out your kids, but 80% of millionaires are self-made. 70 to 90% of wealth is lost in that first 70% in that first generation, 90% in that next generation. So and then the super Roth. One of these things that the effect of tax-free, I think, does ignore is the step up in basis. If you die, so you have a taxable brokerage account and you have 500,000, say you have $1 million and 500,000 of it is capital gains. Well, when you die, that cost basis for all those equities goes up to what the current value is. So say your child is a beneficiary or your spouse, that cost basis goes up to the current day cost basis. So there's zero, if they could sell everything the day you die, actually, let's say for the kid, it could be only 50% of those gains on a spouse, depending on the state. But there's up to that cost basis. You could sell it all and pay zero in capital gains because your new cost basis is the cost basis at the time the person passed away and you became the beneficiary. Make sense? Sorry, I don't think I explained that very well. Okay. Okay, I know if people have a comment, this is a common thing. Hey, I have an old whole life insurance policy. What do I need to do? Unfortunately, I know 2 people that are here that were questioning about this weren't able to make it today. But I'd say on this, don't make any rush decisions. Be patient, evaluate the options. You see actually in the audience, Brittany and I are taking classes together for the CFP. And so she knows a lot more about this kind of stuff. So if you want to reach out, she's a great person to talk to that I think that I trust. So, and in the slides, there's a link. If you click on her picture of the name, it gives her email. Where do I find insurance? Chris, you were talking about that. Whoop, he dropped, unfortunately. Here's certain things that I recommend checking out. Policy Genius is good. They'll go out and search, do all the work, the legwork for you. Haven Life's another good one for, and they're Mass Mutual, so they're 180 years of being an insurance company. And then for me, like I just said, hey, for me, I use USA for home, auto, and my umbrella policy, but not my life insurance myself. And then I'm not going to go through this, but you guys can see this for the slides later. Kind of covers a little bit about each, all the different types we talked about there. And then lastly, did anybody have any questions for me? We're kind of wrapping it up. I know I was already running a few minutes over, so I kind of started moving through those last a little fast. But do you guys have any questions here looking at these? Do you guys have an understanding now, feel like, of umbrella and policy and the different life insurance options? Does anybody have any questions? Good. Thanks, Matt. Okay. Did you find, do you guys find these useful? I think hopefully you do. But if you do, if you don't mind, take some time. We're trying to get the information out to people, and so if you could take a look, subscribe, like, and even take a moment to say how to comment, that'll makes a difference. And share. I know people have made some real positive changes over the things we've done. So if you share what you did, that's going to make a difference where people would actually maybe take a look at these, view these for free, and help their own financial situation out long term.
Hey, Alan, these are posted on YouTube, right? On the channel.
Yeah, there's YouTube, and then I've got a separate, all the slide decks. They're on a, because you can't post slide decks on YouTube. So I've got a link on the YouTube that points you to the website that I made that's got all the slide decks for free. You subscribe, but I don't have any emails. It's just that I see, like I have an idea that people are actually care about it. Maybe if I had time down the road and created a newsletter, I'd send that out, but right now it's nothing. So don't worry about it. There's no fear of subscribing. I hate spam myself. And then here's your homework. Go check your auto and homeowners / insurance, renters insurance policies, check those liability limits, talk with somebody to make sure, get your umbrella policy set up. You need to make sure you've calculated your net worth correctly. Does anybody need, I've shown you guys before though, a good net worth tracker, but if you need one, shoot me an email and I'll send you one that's got instructions as well, but I think you'll like it. If you want, I can show you, I've got it in a backup slide. Verify your beneficiaries, all accounts. Do that. You should do that annually. And now, like I said, it's November. Hey, raises are coming, so update your allotments and invest more of that. Don't spend all of your upcoming raise. Put more away. We're still in a bear market. Now's the time. That it's going to recover. Businesses will continue to innovate and make money. So pump as much in as you can now. Okay, other topics to explore. I've lined out, here's the ones we have already covered. Happy to repeat those as well for people that are interested, and we will start repeating those. There is already some interest, but anybody, if, I guess you could probably, but here's some other topics, and any other thoughts, any other ideas topics people want to share or to discuss, let me know. Okay, any other questions? I think that's about it. I'll show, let's see, I'm gonna actually go to, whoops, I stopped screen sharing. I was gonna try to share a specific slide. show you guys real quick. Okay. And I'm going to share again real quick. This is the net worth tracker that I use. Basically, if you guys want to see. Okay. But it breaks down your cash, your taxable assets, your Roth investments, your traditional. I just threw some numbers in there, you know, as an example. Your child savings and charity, homes, debts you have, and then sums it up in your totals with including what your net worth is, your financial, your liquid FI, financial independence assets, and then I added this to where it breaks down like your pie chart of what's, you know, what's real estate, what's Roth, what's taxable, and what's, you know, pre-tax. Okay, any other questions or thoughts?
Is that available to everyone, or is it just something that you made for yourself?
No, I made, well, no, that's what I said. If you want it, I've got it, and I've got a sample where I filled out a couple of columns, and that way, you know, hopefully makes it even easier to fill out. But yeah, if you're interested, let me know, and I'll shoot you, I'll email you a copy. And I guess I need to, I'll put that up on the website as well, so that people have that as a sample. Well, an action item. Okay. Okay. Great. Well, thanks everyone. I think that's, I'm going to stop recording at this point. Let me see.